A very good morning, friends. So, welcome back. We started off a journey on financial instruments in the last class, and we learned a few aspects. I think before I take the journey forward, let's just stick at a very basic input in terms of what we learned in the next last class, and then I can take the journey forward. So, I basically given you exposure in terms of Ind AS 32, wherein we decided a simple three-step model which will help you to decide whether an instrument issued by the issuer is a financial liability, or is it equity instrument, or is it a compound financial instrument. We also had a three clarification charts also where we looked into the permutations and combinations and identified, depending upon the mode of payment is cash or the mode of payment is equity shares or a mix of the two, how does the instrument gets classified. The main focus points, what we learned is that if the mode of payment is cash, you need to be very careful on the wordings. As far as return is concerned, mandatory, discretionary. As far as the principal is concerned, redeemable, irredeemable. And if the mode of payment is supposed to be equity shares, your focus point comes is the contract derivative in nature or non-derivative in nature. If it is non-derivative, you apply the fixed test and you just look at the number is fixed or variable. And if it is fixed, it becomes equity. Otherwise, it becomes financial liability. If it is a derivative instrument, you need to apply a fixed for a fixed test where you need to see the consideration is fixed, the number is also fixed, and it becomes equity instrument. Any one or two elements becomes variable, it becomes a financial liability. And of course, you need to run this three-step model for each component of the obligation, apply it to the return concept separately, apply it to the principal component separately. Then we came to the inputs in terms of accounting for a compound financial instrument. And I gave you that generally, if there are optionally convertible instruments, they would become compound financial instruments, because the issuer would generally never pay interest which prevails on a non-convertible instrument. So you need to apply a split accounting, and in terms of split accounting, you calculate the financial liability, which is the present value of unavoidable cash outflow. The principal and the interest which is paid is discounted at the benchmark rate, which is the interest rate on a non-convertible instrument. And any balancing figure from the proceeds minus the financial liability becomes the equity component. We also saw a detailed ledger in terms of financial liability and also looked into the concept of equity component, which is ultimately shifted to the tab number 2 of statement of changes in equity. From the equity component of CFI, it shifts to reserve and surplus. Depending upon the facts of the case, it gets transferred to the capital reserve or the share premium, as the case may be. Now, there is one more small agenda which I need to illustrate to you, and which is the treatment of transaction cost in terms of compound financial instrument. So before we take the journey in terms of Ind AS 109, I'm just going to do one more question on the concept of the role of TC, transaction cost, in terms of compound financial instrument. Now, in this particular case, there will be a little more technical calculations to be applied. So I think first of all, let's take a practical illustration and understand if there is a transaction cost involved, how do you tackle it? Because previously, which we did a question, there was no transaction cost involved in the CFI. So my special agenda which is coming is the role of TC, that is transaction cost, the role of TC, that is a transaction cost in terms of accounting of compound financial instrument is concerned. So this is the special agenda. Before we close Ind AS 32, we want to see how does the compound financial instrument accounted when there is a transaction cost which is given in the question. So I'm just going to take a very simple question which is in the study material itself, but I'll just give you the quick facts out here and then we'll solve that particular question. So we are given some basic facts that, let's say, for example, a company issued, let's say there is a company ABC which is issued, let's say, a total of 10,000. That's the number. So they've issued a total of 10,000. We can say CCPS. Compulsorily, rather, let's call it as triple CPS. Compulsorily convertible cumulative preference share. Compulsorily convertible cumulative preference shares. And let's say this is issued on 1st April X1. And let's say this is at the rate of 150 each. So this is issued at the rate of 150 each. That becomes the face value. Now we're also given that there is a dividend which is payable at the rate of 10% every year. So there is a dividend which is payable at the rate of 10% per annum for each year. And I'm also given that these preference shares are going to be converted into 5,000 equity shares. So we're also given that at the end of the 5th year, since it is a compulsory convertible, you can say it is mandatorily convertible. So we are definitely going to convert this in terms of equity shares. So at the end of 5th year, we will convert this into 5,000 equity shares. That's at the end of the 5th year. I'm also given two more informations, and one information is that there is a transaction cost which is 2%, and it is 2% of the proceeds. So whatever is the total proceeds of the instrument, 2% of that is supposed to be a transaction cost. And we're also given the rate of interest. We're also given the rate of interest on non-convertible financial instrument. NC, that stands for the non-convertible instrument. Let's say it is 15% per annum. That becomes basically a benchmark rate. So very simple and straightforward facts. So the date of conversion is going to be 31st March X6. That's the 5th year end. That is supposed to be 31st March X6. Okay, so this is the input which is clearly given in the question. And I think we can also give you the transaction cost. It works out at 30,000. Whatever is the total proceeds, 10,000 into 150, 2% of that works out at 30,000. That is the TC. And let me also give you the face value of the shares. The face value of the equity share is supposed to be 10 rupees per share. I think that's it. No other facts, simple and straight. So we need to look into the accounting of this particular instrument for the entire period of 5 years. So I think let me just consolidate the inputs to you and then we take the journey forward. So I am given in the question that there is a compulsory convertible cumulative preference shares and the company issued a total of 10,000 shares at the rate of 150 each. So the total proceed is 10,000 into 150. Then we're given the dividend is at the rate of 10% and the principal is going to be paid in terms of 5,000 equity shares with a face value 10 at the end of 5 years. The benchmark rate is also given to me. It's at the rate of 15%. And the only thing is the transaction cost, which is 2% of the proceed, that works out at 30,000. Now, let's see how do we account for this particular case. Let me also tell you, a similar question came in the exams as well. But the good part in the examination question was that there is one more information which is required. And that information was already given in that question. But in this question, I have intentionally not given you that information because I also want to tell you that if that information is not given, how do you locate that information? So, but when it came in the exam, that information which I'm talking of was already given in the question. So let's begin the journey. Well, at the first instance, what you need to do Just forget about the concept of a transaction cost and proceed with the question absolutely in a normal manner. Just keep the TC aside and do the split accounting and proceed accordingly. So what we're going to do at the very start, we're going to do the split accounting. So we have the total proceeds and the total proceeds of the instrument is 10,000 preference shares at the rate of 150 per preference share. So we can get the proceeds, and that is 10,000 into 150. That works out, I guess, at 15 lakhs. So this is to be split between the financial liability component. Now, one simple little input which should immediately come to your mind, and that is when you are considering the financial liability, I give you an input, but I'm going to elaborate that input at this stage. The financial liability will comprise of, you can say, unavoidable cash outflow. Mind the words. I'm looking at the unavoidable cash outflow. Now, in this particular case, being a compulsory convertible instrument, I am only required to pay the interest, which is the dividend in this case, which is going to be for the next 5 years. The principal is not paid in cash. If the principal is not paid in cash, in terms of calculating financial liability, we are not going to consider any principal element. So be careful. When you're looking at the financial liability, you need to see the present value of all the future outflows in cash. So in this particular case, the financial liability will comprise of only the dividends to be paid for the next 5 years. There is no principal repayment in cash. The principal is being converted in terms of 5,000 equity shares at the end of 5 years. So there is no outflow in terms of cash. So when you consider the financial liability, we will only consider in this given example the present value of dividends which we're going to pay for the next 5 years. So let's calculate the present value of the dividends. So we know that 15 lakhs is the total value and the dividend is paid at the rate of 10%, and we need the present value interest factor for an annuity that is at the rate of 15% benchmark rate for a period of 5 years. So I think I need your help on this. Give me what is the cumulative factor, which is at 15% 5 years. I think it is 3.352. If you could just verify this to me, up to 3 decimal places, I guess. So 15% 5 years factor, is my calculation correct, I guess? So 1,50,000 into 3.352, I think it comes to 502,800. So this is the present value of the cash outflows in the future. Okay, I hope my calculations are correct. I didn't get any vouching for that, but I believe it is correct. Okay, then finally, we can take the equity as a balancing figure. So out of the total proceeds of 15 lakhs, you reduce the financial liability. So we get the balancing figure 997,200. That becomes the equity element of the compound financial instrument. So you can notice something that at the first start, I have not taken any TC into account. We proceed with the question absolutely in a normal manner. And in this particular case, the proceeds have been split in terms of liability as well as the equity element. Now comes the role of the transaction cost. So what do we need to do now with the transaction cost? We know the transaction cost is 30,000, which is already given in the question, 15 lakhs into 2%, that is the transaction cost. Now, this transaction cost is the cost of raising the entire proceeds, which means it is the cost of raising the liability as well as the equity element. So what you need to do, you need to basically allocate this TC in the ratio of financial liability and the equity component. So this 30,000 is going to be simply divided between the financial liability and the equity component in the ratio which we have calculated. So let's divide this in the ratio of 502,800 is to 997,200. So this will be split between what relates to the financial liability component and what relates to the equity component as well. So let's divide this. So this comes to 30,000 into 502,800 divided by 15 lakhs. I think this is coming to 10056. And this becomes the remaining balance. That is, I think, 19,944. Right. So this is the split of the transaction cost between the financial liability and the equity component in the ratio of FL as well as equity. Now the main question what comes to the mind is, what are you going to do with this transaction cost? I think you can also tell me with your inputs that what do you think you're going to do with this TC? Is this TC going to be adjusted against the liability? Or is this going to be taken in the profit and loss account? What is your inputs on that? So what are you going to do with this TC? Is it going to be taken to the P&L or is it going to be adjusted against the financial liability element? I think I'll have to answer that on a Sunday morning.
It can be taken to the financial.
Yes, it has to be adjusted against the financial liability. That is right. So this will be deducted. This will be deducted from the financial liability element which we have computed. But as far as equity is concerned, this transaction cost will be directly taken in SOKI. It will be adjusted against the retained earnings. This cannot be taken in the profit and loss. So this will be, you can say, directly. This will be directly charged. This will be directly charged to equity. So in the brackets, I'm putting it will be taken to SOKI. There is statement of changes in equity directly adjusted against the retained earnings. Now, the moment you split the transaction cost and you decide the accounting treatment, now there is a small little agenda which you need to do. The problem is if this TC is adjusted against the financial liability, I will not be able to consider the interest rate for the purpose of my leisure at the rate of 15%. Because when you did the split accounting, this calculation was purely based on a 15% rate. But this calculation is ignoring any transaction cost. So what means that if in the question you are given a TC, there will be a need to recompute, you can say, the internal rate of return, or you can say the effective interest rate. Because the calculations of the financial liability right now is based on the fact that you are saying that there is no TC. But if you're going to adjust from the proceeds of the financial liability, you're going to reduce the element of TC, there will be a need to recalculate a new effective interest rate. Now, when this question came in the exams, the new effective interest rate was already given in the question. But I wanted to do a question where the effective interest rate is not given. Then what do? You want me to show the workings of the EIR, or can I comfortably take the EIR? Your choice. If you want, I can directly take the new EIR.
Please show sir how to calculate.
Okay, wonderful. So let me show the workings now to you. So we can say as soon as you see the concept of TC, remember there will be a need to calculate a new effective interest rate as well, without which a leisure account cannot be prepared. So what we're going to do at this particular stage, we'll apply a financial management concept. So earlier, you can say you had an outflow in terms of the financial liability element. So let's put it like this. Let's see from the investor's point of view. Let's see from the investor's point of view. You need to evaluate and calculate your EIR from an investor's point of view. So imagine you're calculating internal rate of return. So in this particular case, as an investor, what is the cash outflow? And as an investor, what is the cash inflow? I can say from the investor's point of view, how much money do you invest? 502 800. So you can say the outflow at time zero is supposed to be 502 800. And what is the inflow for the next 5 years? Can I say you are getting a dividend of 1,50,000 for the next 5 years? So you can say, if you look at the deal from the investor's point of view, what is the internal rate of return? The internal rate of return is when the present value of all the inflows equals the outflow. So you can say the inflow is in terms of getting dividends for the next 5 years. So the present value of all this 1,50,000 discounted at the rate of 15% comes equal to the outflow. That's why 15% can be called as IRR, or it can be called as an EIR, effective interest rate. In financial management, you call it as IRR. In terms of financial reporting, we call the same thing as EIR, that is effective interest rate. Now, the moment we decided that we will reduce the amount, that is the transaction cost of 10056, this means the cash outflow goes down. Now I have a quick question to you. The moment you reduce the transaction cost from the outflow goes down. So is this going to increase the internal rate of return, that is EIR, or is it going to decrease the internal rate of return? With the same inflows, the outflow goes down. With the same inflows, you can say the outflow goes down. So is the IRR going to push up, or is it going to push down? Any inputs on that? What do you say? Is the EIR going to push up, or is it going to push down? Apply the basic financial management. Same inflows, the outflow has gone down. Lesser outflow, and you've got the same inflow. So is the IRR going to shoot up or shoot down? Shoot up. Undoubtedly shoot up. So we can say the internal rate of return, or you can say the effective interest rate, undoubtedly will increase more than 15%. So earlier your EIR was 15%. Now it will definitely go up. And I think it's a simple mathematical logic that in terms of the inflow, it is same, but the outflow goes down. So when the outflow goes down, you're getting the same inflow with lesser amount of investment. Your internal rate of return has to push up. So what we're going to do in this particular case, use a hit and trial method. We're going to use a hit and trial method in terms of calculating the effective interest rate, or you can say the IRR. So you can simply create a range. Let's say I create a range of 15 to 16%, though it is dangerous to create a range which is too narrow. You should ideally create a range of almost like 15 to 17 or 15 to 18. Spread the range to at least 2 to 3%. But since I already know the answer in advance, I am taking the risk of taking a range which is smaller. So what we need to do, we need to calculate the NPV at 15% and at 16%. We're doing the same exercise what you do in financial management. So we're going to calculate the net present value, the NPV at 15 and 16%. And if you get a positive NPV and a negative NPV, your range is set. So let's again calculate the NPV from the investor's point of view. So from the investor's point of view, we've got the present value of cash inflow minus the present value of cash outflows, and we will be able to calculate the net present value. So in this particular case, if I consider the inflows, that is 1,50,000 for the next 5 years. Here also 1,50,000 for the next 5 years. And now we need the cumulative factor as well. At 15%, I think I've already taken the factor. That was 3.352. So this is 3.352. Let's see the factor at the rate of 16%. I guess it comes to 3.274. So this is the cumulative factor, 16% for a period of 5 years. So we've taken the present value of all the inflows at the rate of 15%, at the rate of 16%, hit and trial. Now, what is my outflow? My outflow is this amount now, which is after reducing the transaction cost in this particular case. So 502,800 minus 10056, this works out at 492,744. So this is 492,744 after making a reduction of the TC. Now, I'm pretty confident that we are going to get a positive NPV at the rate of 15%. And since you made a reduction of the TC, I think my NPV at 15% is going to be equal to the TC itself. Let's see. 1,50,000 into 3.352 minus 492,744, you're getting exactly an NPV equal to the transaction cost, and that's about got to be. Because at the end of the day, what you've done, you've taken the same inflow and you've just taken a reduction of the TC. So in this particular case, your NPV undoubtedly has to be equal to the transaction cost itself. So we've got a positive NPV at 15%. So we need to get a negative NPV at 16% to say that the range is absolutely correct. So this works out at a negative NPV at 1644. Since we get a negative NPV at 16%, I think undoubtedly we can say that my internal rate of return is between the two. Don't worry, I'll consolidate the picture. Now, the best part was that all these calculations were not required in the exam, because the calculations of the new internal rate of return was already given in the question. Now what I need to do, I need to basically use interpolation, and with the help of which we'll calculate the effective interest rate. So if I calculate my new effective interest rate, we'll take an interpolation. So in this particular case, your answer is definitely in between the two. I think I'll directly apply the FM concept. So we'll take the lower limit is supposed to be 15% plus the NPV at 15% divided by the difference in the NPV. So when you divide the difference, so this minus this will become plus. So 1644, and the range is supposed to be 1%. So we will be able to calculate the new effective interest rate. I just applied the concept, the lower limit, NPV at the low rate divided by the difference between the NPV at lower and the high rate into the gap of the range, which is 1%. So I guess this comes to 11,700. I guess this is coming to around 15.86% approximately. So this is coming to 15.86% approximately. Wow. The best part is whatever efforts I've taken to calculate this 15.86, that was already given in the question. Now, before we proceed, I think let's take a quick recap in terms of what is to be done. So let me remind you, what we're looking at is a special issue when there is a transaction cost given in terms of a compound financial instrument. What is the role or what is the accounting of a TC in terms of CFI? So at the first instance, what you need to do, you need to first of all do a normal calculations. Ignore the TC, do the split accounting, get the financial liability and the equity component. That's one. Second, what you need to do in this particular case, you need to basically divide the TC in the ratio of FL and equity. Whatever split accounting you've done, you're going to divide the TC in the ratio of FL and equity. The TC relating to equity is directly taken to SOKI, charged to the retained earnings. And the TC which relates to the financial liability is deducted from the amount of financial liability. This deduction would lead to the calculations of a new EIR, that is the third focus point. So I think let's make your life simple. That if you're given a TC, there is going to be three steps to be applied. Number one, do the split accounting the usual manner. Number two, divide the TC in the ratio of the FL and equity. And number three, get prepared to calculate the new effective interest rate if not given in the question. The chances are bright because if you look at the past trend of the examination questions, whenever there is a TC, generally the examiner tells you that what is the new effective interest rate. But if it is not given, you need to think from the investor's perspective. You need to think that as an investor, what is your investment in terms of liability and what is your cash inflow? Now, when you're going to reduce the amount of TC from the outflow, naturally, with the same inflows and a lesser outflow, your internal rate of return has to push up. So we understood that IRR is definitely more than 15%. Using a hit and trial, I created a range of 15 to 16. Calculated by NPV at 15 and 16, you should get a positive NPV at a lower limit and a negative NPV at an upper limit. And therefore, with that range, you do the interpolation and you get the effective interest rate. I hope the process is very clear. The three steps involved if a TC is stated in the question. Now, with this new EIR, we will be in a comfortable position to make our leisure accounts for the financial liability. So let's now go on to the preparation of the leisure account. So as usual, as we did in the previous class as well, let's, I think, create a financial liability ledger as well. Now we need to be very careful as you prepare a financial liability ledger as well. When you go to prepare a financial liability ledger, remember the amount of financial liability has to be recorded net of TC. So I'm going to put this amount by bank, and this is net of TC, which we've already calculated. The amount which is net of transaction cost is 492,744. This is 492,744. Now, when you are going to consider the finance charge, we are going to unwind this finance charge at the rate of 15.86%. That is the reason we calculated that. If there was no TC, you would have taken the financial liability 502,800, unwinded the interest at the rate of 15% itself. But since this amount has got adjusted because of TC, we were calculating the new effective interest rate. So let's see what is the finance charge at the rate of 15.86% on this. So 15.86% comes to 78,149. And is there a payment which is made at the end of the first year? Yes. We paid a dividends at the rate of 1,50,000. So we can comfortably take the balance CD as, and this ledger will go on for the next 4 years because we've got a total of 5 years. So I'll quickly make the ledger for the next 4 years as well. So let's see what is the balancing figure. I guess it is 420,893. This becomes the balance for the next year. Again, take the finance charge at the rate of 15.86%. It comes to 66,754. And again, we made a payment to the extent of 1,50,000. So we get a balance CD as a balancing figure, which is going to become the balance BD in the next year. This is, I guess, 337,647. By the way, let me ask you a question as well. What do you think will be the balance after a period of 5 years? If you prepare your ledger account for the next 5 years, what do you think the balance in this ledger account will be? Will there be any balance or will it become zero? So let's take the interest 15.86, 53,550. And again, we make a payment to the extent of 1,50,000. I didn't get any answer on that. Oh my God. I think I'll have to answer that question again. It'll be zero. So this works out at 241197. Let's make the ledger account for the next 2 years as well, so that we get a complete clarity of thought. So let's make the ledger for the next 2 years as well. So this becomes the balance BD 241197. Again, we take the finance charge at the rate of 15.86% on this. That works out at 38,254.50, and we get the balance CD as a balancing figure. I guess this is 129,451. And in the last year, do not calculate the interest. I will take this as a balancing figure because I know the payment is to be done to the extent of 150. So you can make the payment and take the finance charge as a balancing figure to get more accurate results. And that is 20549. You can also make a cross check whether this interest is coming to 15.86% on the opening balance. Yes, it is approximately coming to 15.86% itself. So which means a ledger account is made absolutely correct. So this is the accounting or the financial liability element of the CFI. Now let's also have a look in terms of how the equity component will be accounted in terms of SOKI. Last class itself, I'd given you that the equity element is going to be presented in the tab number 1 of SOKI. But now let's see what are you going to do with this particular amount. So let's have a look on the equity element as well. So let's say this is my extract SOKI. This is my tab 1, tab 2 and tab 3. So this is my statement of changes in equity. So this is the equity component of CFI. This is the reserve and surplus, and this is the other comprehensive income, tab 1, tab 2 and tab 3. Now the equity component of the CFI is being kept in the tab number 1. So we've already computed that balance. And when you're going to consider the equity component, please do not consider the equity component net of TC. Just take this figure because this would have been charged to equity in terms of retained earning. So the amount which goes in tab 1, 997,200. So this must have been written out here. 997,200 is the equity component of CFI. Now the question rises that where will this money go at the end of the year? Can I say at the end of the year, this money is going to be used for the purpose of allotment of equity shares. So let's see the journal entries now at this stage. So we can say the equity component is going to be given a debit that is 997,200, against which allotment of equity shares will be done. Against which allotment of equity shares will be done. So be careful. This entire amount will not enter into the tab 2, unlike what we did in the previous case. Because in the previous case, if you remember, the amount of financial liability was the sum total of the interest and the principal both. So the allotment of shares took place against the financial liability ledger itself. This is a compulsory convertible instrument. So whatever amount of element is there in the equity component, that's not going to be directly shifted in tab 2. This money will be used for allotment of shares. So we are already given in the question that 5,000 equity shares with a face value of 10 will be given. So the allotment of 5,000 shares into 10 will be given. The balancing figure is going to be a share premium. So this difference, 997,200 minus 50,000, 947,200 is the balance in the share premium. So which means that the amount of tab number 1. So this is partly getting transferred to two different elements. So out of this, you can say 50,000 becomes equity share capital, and the remaining amount, that is 947,200, is going to enter as a share premium in the tab number 2. So that is how the accounting for the equity component will be done at the end of 5th year, when the compulsory mandatory conversion into equity shares will take place. I hope, friends, I am absolutely clear on the agenda of the TC and the use of equity component at the end of the 5th year. These were the two main agendas in the question: understanding the role of TC in our calculations, and understanding that the equity component is not always transferred to the tab 2, but it is only once the allotment of share takes place, only the excess over the face value enters in the tab number 2 as a share premium. Right, I hope I am pretty clear on the role of TC and the other issues. Right?
Yes, sir.
Wonderful indeed. So this, I think, appropriately takes care of the concept of Ind AS 32. So we've got two agendas covered. I would say rather three agendas: deciding whether the instrument is presented as equity, liability, or CFI. Agenda number 2, accounting of a CFI without a TC, and accounting of a CFI with a TC. That's how you map your mind. Now it comes to the turn. We're going to start with the next area of financial instruments, and that is Ind AS 109. Now, I don't know that how much comfortable you are in terms of other comprehensive income, and how much comfortable you are in terms of understanding the different measurement base, because we are doing a revision. So I'm still going to take some time to give you some conceptual understanding of the different measurement base. Shall I take the honors that you may not be very clear with it? So let me spend some good time. Good idea. Brilliant idea.
Yes, sir.
Great. So I am now coming to Ind AS 109, which deals with the core accounting, that is recognition and measurement. Now, I'm going to create a good base so that, in the next class tomorrow, I can do a lot of questions with you. My base today is going to be very important because I want to practice more questions on this area from the examination point of view. So I'm going to create a good base and then use this opportunity to do a lot of questions with you on this area. Now, let's first begin. In terms of Ind AS 109, my focus is now on the accounting of financial assets. So I'm now switching over from the aspect of issuer to the aspect of holder. Now, before any confusion sets in, let me, I think, clarify one thing. Ind AS 109 is not dealing only with the accounting from the holder's point of view. It covers the accounting of a liability as well as the asset both. But for the moment, my focus is I want to look into the accounting of financial assets. Now, Ind AS 109 has made it very clear that when you look at the accounting of financial assets, the accounting of financial assets can be divided in two sections. One is the initial measurement. And the standard very clearly makes a mention that financial assets initially are always measured at a fair value. Financial assets are always initially measured at a fair value. They are not measured at cost. They are always initially measured at a fair value. But then there are certain exceptions where financial assets are not measured at a fair value. So let me also give you those exceptions as well. So there are two exceptions when the financial asset is not measured at a fair value. One of the exception is accounts receivable. And the second exception is a loan which is recoverable on demand. Loan which is recoverable on demand. You've given a loan to someone and you can demand that money at any point of time. That's called a loan recoverable on demand. So we can say that in these two cases, that is account receivable and loan recoverable on demand, the initial measurement is done at what is technically called a transaction value. So in these two cases, the initial recognition is not done at a fair value, but it is done at what is called a transaction value. So what is a transaction value? The value at which you did the transaction. So let's say, for example, I made a credit sale to the customer, let's say for 8 lakhs. That's my transaction value. So account receivable and loan which is recoverable on demand is going to be recorded at a transaction value. But all other financial assets other than these two are always recorded at a fair value. Then comes the input that what is the subsequent accounting of financial assets. In terms of subsequent accounting of financial assets, the standard has given us some parameters. And based on those parameters, we may land up recording a financial asset at any of these models. It might be recorded, let's say, at amortized cost approach, or it might be recorded at a fair value through other comprehensive income approach, or it may be recorded in terms of fair value through profit and loss approach. So financial assets subsequently are going to be measured at amortized cost, what we call in short as AC. So financial assets may be subsequently measured either at amortized cost or at a fair value through OCI or at a fair value through P&L, depending upon certain parameters. And I have segregated those parameters into, again, a simple three-step model in life to make the life simple. So get the chain very clear, because what am I going to do in the next, leftover time in the class is going to create a very strong base with you, with the help of which we'll do a lot of practice area in terms of the crucial part of the standard. So remember the basic framework that financial assets are initially measured at a fair value with the two exceptions. And subsequently, the financial assets are measured either at amortized cost or at a fair value through other comprehensive income or a fair value through a profit and loss. And this will be decided on the basis of parameters which I've translated into a three-step model. But I think the first need is to understand what is this amortized cost. Because we can still appreciate what is a fair value through P&L or a fair value through other comprehensive income. Fair value through P&L means that every year end, the financial asset is measured at a fair value and any changes in the fair value is taken in the P&L. Similarly, fair value through other comprehensive income means every balance sheet date, the financial asset is measured at a fair value and any change in the fair value is taken in the other comprehensive income. So basically, in the second case, the financial asset is subsequently measured at a fair value, where the changes in the fair value, increase or decrease, is taken in OCI. And when you say fair value through P&L, it is again recorded at a fair value, where the changes in the fair value, increase or decrease, is taken in P&L. So FPTPL is recording at a fair value with changes in the P&L. FPTOCI is recording at a fair value with the changes in the other comprehensive income. But in this case, it is a cost approach, so we do not capture any fair value. But what do we do in terms of amortized cost? What is this amortized cost? So I would now take an example to understand the concept of amortized cost. Why did these standard setters, tell us that we need to apply the concept of amortized cost approach? So I'm going to take a simple example. Rather, I'll share the example on the screen so that you can note the facts as well. And with the help of which I will first illustrate the amortized cost approach. After having understood the amortized cost approach, I'll come to the three-step model so that we understand that in which particular case, which particular approach is to be applied. So let me first share a small little question to you so that we can understand, appreciate the concept of amortized cost. Just give me a second. I will share something interesting to you. So So this is a wonderful question which will help us to understand the insights very clear. So I'm just going to share a small little question on the screen. Just watch the inputs. This is a question not from the study material, but I've just taken it from some source in order to get a complete understanding of the concept. So I'm just sharing a question to you on the screen. We'll note down the main facts as well, and then we'll start working on this. So please have a look at this particular question, and let me give you some analysis based on this. It says on 1st January X1, Tokyo bought 1 lakh 5% bond for 95,000, incurring an issue cost of 2,000. That is supposed to be a transaction cost. That when you invested in a bond which has got a face value of 1 lakh, you invested 95,000 and you also incurred a transaction cost of 2,000. The interest is received in arrears and the bonds are redeemed at a premium of 5960 over a face value on December X3. The investment has got a total of 3 years of life, X1, X2, X3. And see, the effective interest rate is given to me, it's at the rate of 8%, and the fair value at the end of first year and second year is given. So I think let me now start analyzing this particular question. I want to do some analysis with you on this particular question and then understand this. Now I'm going to put some sentences to you as I read the question, and you need to vouch me on this because your vouching is going to be very important to understand the essence. It says on 1st January X1, Tokyo bought 1 lakh bonds for 95,000. Did the issuer do you a favor? Did he did a favor to you?
Yes,
When
sir.
he issued the bonds at a discount, did he pass on a favor to you?
Yes, sir. 5,000 is
Absolutely
favor.
correct. So
Discount.
the implication of this is if he gives you a discount at time zero, can I say he will definitely give you a lesser interest? If the bonds were issued at a par value, let's say if it was issued at a par value, he would have given, I'm just assuming an arbitrary figure. Let's say if the bond was issued at a par value, he would have given you a 6% coupon rate. Can I say if he issues at a discount, he would reduce the coupon rate below 6%? Is my thoughts correct?
Yes, sir. Correct, sir.
Absolutely. Similarly, I'm also given in the question that the bonds are redeemed at a premium over and above the face value. Can I say if he's going to pay you a premium over and above the face value? Can I say that's another favor which is done at the end of the third year? So in this particular case, again, since he is paying you a premium over and above the face value, can I say he would land up giving you a lesser coupon rate? Is that also making sense?
Yes, sir. Definitely.
Absolutely. So I would say if you look at a particular question and there is a discount on issue, or there is a premium on redemption, mind the words, there is a discount on issue, or there is a premium on redemption, one thing is very clear that the issuer will never pay you interest rate at market terms. He will always pay you interest below market terms, which means the 5% coupon rate which is given in the question has been suppressed. The 5% coupon rate which is given in the question has been suppressed. And that 5% coupon rate is reduced because he gave you a discount at time zero and he's giving you a premium on redemption. So the standard setters understood one thing, that do you think your real interest income is 5%? No. Because we can say that when he gave you a discount on issue, it is indirectly giving you interest. When he gave you a premium on redemption, it is indirectly giving you interest, which means that my interest rate should incorporate the premium on redemption. My interest rate should incorporate the discount on an issue. And you can notice that we are given the effective rate of interest, and that is at the rate of 8%. So I think there is two aspects we've understood. If the question tells me a discount on issue, one thing is very clear, the coupon rate is a suppressed rate. If there is a premium on redemption, one thing is very clear, the coupon rate of 5% is again a suppressed rate. The real earnings is not 5, but the real earning is definitely more than 5. In this case, the real earnings is already given at the rate of 8%. You want me to explain that if this 8% was not given, how do you derive that 8% as well? Or can I comfortably go with the 8% figure?
Sir, here also the transaction cost also involved. For that also interest is
Absolutely.
reduced.
Yes. So I can say that you rightly said there are three factors which is changing the effective earning from 5 to 8%. One is the discount on issue. One is the premium on redemption, and one is the presence of TC. And I can make a very strong statement that if in the question you find any one or all the three elements or more than one, there will always be a presence of an effective interest rate. The moment you read a question and you see that there is a discount, or you see that there is a premium, or you see that there is a TC, undoubtedly your mind should tell you that there is a need to calculate an effective interest rate. So do you want me to calculate this 8%, or can I comfortably go with this 8%? Or just give you a basic structure how this 8% will be taken?
Please explain the calculation, sir.
Okay, wonderful. I'll do that. So now what do we need to do in this particular case? You need to visualize this particular transaction again from the investor's point of view. Every time you want to calculate the effective interest rate, start looking at the deal from the investor's point of view. Now let me ask you a few questions. If I were to calculate the internal rate of return, if I were to calculate the effective interest rate, or you can say internal rate of return, can I say what is the outflow at time zero? Can I say the investor made a purchase of the bond at 95,000? So at 0 point of time, he invested 95,000 in the bond. That becomes an outflow from the investor's perspective. But then he also incurred a issue cost, which is a transaction cost to the extent of 2,000. So 2,000 is supposed to be another amount invested. So this becomes a total outflow at time zero. When he invested in the deal, he paid 95,000 and 2,000 issue cost as well. But what did he get in return for the next 3 years? Can I say over the next 3 years, he's going to get the coupon rate of interest on the face value. Remember, the 5% coupon rate is going to be received on the face value and not on 95. So you're going to receive 5,000 at the end of each year. And at the end of third year, you're also going to get the principal money back with the premium which is payable. So you will get that 1 lakh rupees of face value, including the premium of 5960 as well. So what I've basically done, I've documented the entire deal in terms of inflows and in terms of outflow. Looking at the investor's perception, we said, let's have a look that these are the outflow, the money invested and the transaction cost, the interest received for the next 3 years, and the principal with a premium. Now, what do you need to do? Apply again a hit and trial.
Present value
Again,
of
consider, yes. So again, you need to consider that what is the discount rate at which the present value of all this money equals the cash outflow. You need to locate the internal rate of return, and that works out at 8%. If you're going to calculate at 8% the present value of all these inflow, it'll definitely equal to 97,000. Let's make a cross check. Let's see that if I were to calculate the internal rate of return, which is already given to me at the rate of 8%, is this coming the same? So let's see what is 5,000. Let's see at the rate of 8%, the cumulative factor. So this is coming to 2.577, and you're going to get 105960 at the end of the third year. So my factor at the end of third year is 0.794. So since I already know 8% is the internal rate of return, what I've done, I've taken the discounting of the interest for the period of 3 years and the discounting of the principal at the end of the third year. So let's see what is this figure turning out to be. 84,132.
97,017.
That's right, 97017, which is approximately equal to 97,000, which means 8% definitely is the internal rate of return. But the moral of the story is, which you need to keep in mind when you proceed with any question, and I think that's the crucial issue which I would like to mention at this stage. If in the question you find any of these three things, you see that there is a discount which is given in the question. You see that there is a premium which is given in the question.
On redemption.
And yes, it could be a premium on redemption. It could also be a premium on issue. There could be a discount on issue or maybe a discount on redemption. Therefore, I'm very crucially writing the word discount and not discount on issue. So you need to see that there is a discount on issue or redemption, premium on issue or redemption, and if there is a transaction cost, undoubtedly this will lead to the need to calculate a new effective interest rate, 100% guaranteed. So next time when you focus on any question and you read the question, the bell should start ringing into your minds. When you read the question and you see that there is a TC, EIR, you read a discount on issue, premium and redemption, or maybe on issue, redemption, whatever, EIR. So these are the three inputs which will lead to the calculation of the new effective rate. Because the coupon rate which is given in the question, like 5%, is not the effective interest earning. The company, the investor, is definitely earning much more than that, because the issuer is compensating the low rate of interest by giving you a discount. He's compensating the low interest by giving you a premium on redemption. So the effective interest earning is definitely beyond 5%. And in this example, it is 8%. I'll give you some more reconciliations to understand the concept better. So the standard setters decided that when a deal is structured, let us see what is the effective interest rate in the deal. And the interest income is not going to be recorded in the P&L based on what you're getting, but based on what you're effectively earning. I might be getting a 5% interest every year, but what I'm effectively earning every year is definitely more than that. It's 8%. So let's see how the ledger account is going to be prepared. So in this example, let's see the accounting of this financial asset. Let's see the accounting of this financial asset, which I want to prepare at amortized cost, at AC. So indirectly, we're looking at the calculation, the financial asset accounting at AC directly here itself. So when you made an investment, financial asset gets a debit, and this is also going to be including the TC. So there is one more important input which comes to the mind. If there is a TC related to financial liability, it is deducted from the financial liability. Remember the question on compound financial instruments. And if there is a TC which relates to a financial asset, it is added to the amount of financial asset. So we'll be making a chart also very soon, understanding what is to be done in each and every case, because there are three combinations: AC, OCI, and P&L. But one thing is very clear for the time being, that if there is a TC related to financial liability, it is reduced from the FL. And that leads to the calculation of EIR you have just seen, 15 to 15.86. If there is a TC relating to financial asset, it is going to be added to the financial asset. And we've already calculated the EIR. So this works out at 97,000. Now the France income to be recorded is going to be again recorded at the effective interest rate. We're going to record the interest income at the effective rate, which is 8%. So let's see what is the France income at the rate of 8%. So that works out at 7760.
7760.
Correct. Receive the coupon rate of interest on the face value. So on 1 lakh rupees of face value, you get a
5,000.
5% interest, that is 5,000. But what I'm going to record in my profit and loss account is not 5,000. What I'm going to record in my profit and loss account is the interest effective income. So this goes in my profit and loss. This does not go in my profit and loss because 5,000 is what you're receiving in cash. But the effective earnings is this. So this enters the profit and loss statement. Let's as a balancing figure. And then again, we'll take the finance income on this. So this is
99,760.
99,760, and this becomes a balance BD in the next year. We again take a finance income at the rate of 8% on this. 7981.
81.
And again, we receive that 5,000 coupon rate again and get the balance CD as a balancing figure. And that's, I think, 102741.
Right, sir.
That's correct. And then in the next year, again, we've got a finance income. But I think I'll take the finance income as a balancing figure in the last year to get more accurate calculations. Now, what are you going to receive at the end of the third year is the 5,000 coupon rate and also the face value with the premium as well. So you're going to receive that 5,000 and the face value along with the premium 5960. So you can take the interest as a balancing figure for accurate results.
It's 8219.
That's right, 8219. And you can make a cross check as well that is this coming effectively at 8%, just to be very sure. I think, yes, a difference of maybe 3-4 rupees or something. So we
Yes.
are getting exactly the same finance income as well. My job is not done. I want to now show you something very interesting to understand the larger concept of amortized cost approach as well. So this is the technique we have learned that what is an amortized cost approach. Now let me make a very strong statement again. In terms of financial instruments, Ind AS 109, there is no historical cost approach which is ever applied. Ind AS 109 does not make use of any historical cost approach. The cost approach is a modified approach which is called an amortized cost approach. But let's do one more inputs in this case. I want to see a small little reconciliation in this particular case. To get my larger concepts clear, I want to see a small little reconciliation as well. So one basic thing which we all know that, if there is any income taken in the P&L, ultimately it should be received in cash as well. Whatever you record as an income in the P&L, you may not receive the same amount in the same year. But one thing is very clear that if there is an income in a particular year, you will definitely receive that money ultimately in some year or the other. So let's see what is the credits in the profit and loss over a period of 3 years. So we have taken a credit of 7760, 7981 and 8219. So this is the credits over the period of 3 years. 7760, 7981 and 8219. So let's see what is the total credit to the profit and loss over a period of 3 years based on the effective interest rate. 7760, 7981.
23,960.
That's right. This comes to 23,960. That is the amount of credit in the profit and loss. Now let us also see that the benefits received collected has to be equal to this amount. Now, if I see the benefits in terms of the deal, can I say I got a discount of 5,000 at the very inception? That was benefit number one. But I had to pay a transaction cost of 2,000 at time zero. That was a negative benefit. So I basically got a net benefit to the extent of 3. Then I'm also getting a coupon rate of 5% for the next 3 years. That's another benefit I collected in cash. And I also got a benefit in the form of premium at the end of the 3rd year. So what I've done, I've taken the cash benefits. So this is the discount I received. this is the TC I had to incur, this is the interest I collected, and this is the premium on redemption. Let's see if this is equal to
Yes,
the
sir.
same figure. Yes, it is 23,960. Do you think this is matching by chance or is it got to be? The credit to the profit and loss and the benefits collected, is this by chance the same or do you think it has got to be? 100% got to be. So did you get this reconciliation, I guess? Now I think let me consolidate the picture to you that what is the essence of using an amortized cost approach. Now please hear this carefully. In this particular example which I gave you, two people sat down and made a deal. Two people sat down and structured a deal. So the two people sat down and said, okay, I can't give you 8% interest. Please hear the words carefully. So the issuer is telling the holder, sir, I can't give you 8% every year. The holder says, no, I want 8%. That's the market rate. I said, sir, okay, let me do one thing. Instead of giving you 8%, I give you 5%. He says, what about that 3%? I said, sir, I'll compensate that 3% to you by giving you a discount at the inception. I'll compensate the 3% to you by giving you a premium on redemption. And I said, please also take care of the fact that in order to invest in your company, I had to incur a 2,000 transaction cost as well. So can I say the deal is structured between the two people according to their whims and fancies, according to the liquidity positions. So one party said, I will not give you 8%, but give you 5. And he said, I compensate you by a discount. I compensate you by a premium on redemption. If the two people are ready, the deal gets structured. And I cannot stop, as a regulatory body, I cannot stop two people from making the deal the way they want. But I will not consider their deal as the basis of accounting in my life. If they negotiate a deal at the rate of 5%, I'm not going to capture the interest at the rate of 5%. I'm going to capture the interest in accordance with what you're effectively earning each year. So is the amortized cost approach converting the deal in terms of an effective annual earning? Yes. So the standard setters thought that in terms of financial instruments, two people will always enter into the deal in accordance with the liquidity positions. They agree to any deal. I can't stop them from making a deal. So there is a very structured deal where some benefit is coming at time zero, some benefit is coming over 3 years, some benefit is coming at the end of the third year. But at the end of the day, the discount, the premium is nothing, but it is effectively a part of the interest. And it is effectively part of the interest. So we'll end up calculating what is the effective interest rate, which is 8%. So this is what you're effectively earning each year. Did you get the larger concept of what is the concept of amortized cost approach?
Yes, sir.
Wonderful indeed. So I think now it's time to come back on the chart. I started my journey and I said, I'm going to first make some backgrounds to you. So I'm just coming back on the concept of the initial recognition. So let me just come back on the chart on the financial assets with you. So I'm just coming back on the agenda. I said financial assets initially are measured at a fair value. And I gave you two exceptions where they're taken at a transaction value. And subsequently, I said we will use amortized cost approach, a fair value through OCI or a fair value through P&L. So now we need to understand what are the parameters on the basis of which you will decide that financial assets will be subsequently measured at which particular model. So what I'm now going to do, I'm going to give you a 3-step model with the help of which we will decide, okay, in this particular case, an AC approach should be applied. In this particular case, an FPT OCI approach should be applied. And in this particular case, an FPTPL approach should be applied. But before I give you a 3-step model, I also want to pen down some thoughts at the back of your mind. That the standard setters had a particular concept when they decided that which particular measurement base would apply. And the thought process was based on a risk assessment. So I think before I give you a three-step model, let me tell you the thought process they had in the mind. That the concept of a risk assessment will decide what kind of measurement base is going to apply. I think for that purpose, I need to add on something more to you. So let me, I think, just add something more further at this stage. I'm now looking at the three approaches which I gave you. One is a cost approach, though it is called an amortized cost approach. And one is a fair value, which is through P&L, and one is a fair value through OCI. I want to first understand the implications of these approaches on the income statement and on the earning per share. I want to understand the implications of these measurement bases on the profits and the earning per share of the company to decide which approach am I going to use in which particular case. So watch this carefully. So we've got an amortized cost approach, we've got a fair value through other comprehensive income, and we've got a fair value through profit and loss. Because if you're able to understand this, my three-step model is going to be very systematically giving you answers. Now, I want to first of all understand that if I use a cost approach, are you going to capture the fair value changes? Of course not. An amortized cost approach is only considering the concept of EIR. Nowhere in my financial asset I took any fair value. In the question I gave you fair value, but I did not incorporate the fair value in my ledger accounts. A cost approach will not capture any fair value changes. So my question to you friends, if I do not capture the fair value changes, can you tell me what is the impact on the profits of the company? Will there be any impacts on the profit of the company if the fair value changes are not captured? That's a question to you. You need to analyze this. This needs to come from you. If the fair value changes are not captured, will there be any impact on the profits of the company? I've ignored the fair value change.
Also,
That's right. There will be no impact on the profits and consequently no impacts on the EPS as well. Don't you think so that this is a very, very safe approach for the company? If I tell the company to use an amortized cost approach, any changes in fair value will not impact the profits and the EPS. How safe is that? Now let's consider if you capture the fair value changes in the other comprehensive income, is this going to impact the profits of the company? At the end of the day, other comprehensive income is a part of the profit and loss statement because your income statement has got two sections. One is the profit and loss and one is the other comprehensive income. Added together, we get the total comprehensive income of the company. So if you're going to capture the fair value changes in the OCI, is the profit going to get impacted? Yes. What about the EPS? When you calculate the EPS of the company as per Ind AS 33, what enters the other comprehensive income is never taken in the EPS calculations. So which means that there will be no impact on the earning per share. I hope you get the points very clear. That when you capture something in the other comprehensive income, it definitely is a part of the profits because the total comprehensive income is P&L plus OCI. Now, if you capture the changes in the fair value in the profit and loss section, is this going to impact the profits of the company? Undoubtedly, yes. And is this also going to impact the earning per share of the company? Again, yes. Because what enters in the P&L impacts the earning per share, but what enters the OCI does not impact the earning per share. Now let me ask you something based on this particular analysis. What do you think can be creating a lot of volatility in terms of the company's results? Which approach do you think will create a lot of volatility that if the fair value goes up, the profit EPS up, the fair value goes down, the profit EPS goes down? So which approach do you think is going to create a huge volatility? Is it AC? Is it FPT OCI? Or is it FPTPL? You make your selections. So which approach? That's right. Which approach is going to lead to the maximum volatility is FPTPL. If the company uses FPTPL, a fair value increase means profits EPS up. A fair value decrease means a profit EPS down. So this is going to be a very dangerous approach for the company. So the standard setters decided. This is a thought process I'm giving you. The standard setters decided that the accounting of a company is based on the risk the company takes. Remember, when I was looking at the issuer perspective also, the risk is the factor which decides it's a financial liability or equity. When as an issuer, the risk is on me, it's a financial liability. When the risk is on the holder, it's an equity instrument. The classification of the instrument from the issuer is from a risk perspective. And trust me, the accounting of the financial asset is also from the risk perspective. So the standard setters decided that if in a situation you find that the company has taken more risk, if the company has taken more risk, we will give them a fair value through P&L. Now you would say, sir, how would I make an assessment? At the end of the day, the company is dealing with public money. And if they're taking too much risk, I want a volatility in their P&L. How the risk is assessed is a different story. And that is what we're going to learn in the three-step model. What are the risk parameters? How do you evaluate whether the risk is more or the risk is less is what we're going to learn in the three-step model. But let's keep one thing very clear. If my three-step model, if my risk assessment tells me that the company has taken more risk, in that particular case, we'll tell them to follow an FPTPL. And you can see AC is on one another extreme. If this is one extreme where there is impact on the profits and the EPS, this is another extreme where there is no impact on the profits and ECS. So this approach is going to be used when there is no risk. My risk assessment tells me that there is no risk. I'll use an AC approach. So when I'm going to go to the modalities of risk assessment, so when we reach a conclusion that there is no risk, I'll say AC. When I reach a conclusion that there is more risk, then it is FPTPL. And this is more like a mid approach. Because in this case, you can see the impact on the profits, but you can see no impacts on the EPS. It's more like a mid approach. For when you see that there is less risk, comparatively lesser risk as compared to this approach, then we're going to use an FPT OCI. So I've given you two basic inputs. I'm just going to consolidate the learnings and then come to my three-step model on this. So my mind is now telling me that when you're looking at the accounting of financial assets in the books of the holder, when I'm looking at accounting of financial assets in the books of holder, my mind is telling me, number one, initial recognition is at a fair value, except with the two exceptions where we consider a transaction value. Then the subsequent measurement of financial assets will be at AC, FPTPL or FPT OCI, and which method will be apparently used depends upon the three-step model, but we've decided that risk plays a major role in terms of selection. If the risk is supposed to be high, I'll take FPTPL. If the risk is supposed to be less, I'll take FPT OCI. And if there is no risk, I'll take AC. And we know how the AC approach is applied. If you're applying an AC approach, you need an EIR. The question gives you discount, the question gives you premium, the question gives you TC, it triggers the concept of EIR. But fair value changes are not captured. In terms of FPTPL and FPT OCI, you're going to capture the fair value changes. In FPTPL, the fair value change will enter the P&L. In FPT OCI, the fair value changes will enter the OCI. Now it's time to introduce you to the three-step model. But am I clear, friends, with the thought processes so far? Are you clear with the concept of what is AC and which approach to be applied based on the risk assessment? Then we can go to the next stage. So far, so good?
Yes, sir. 10 out of 10.
Wonderful indeed. Now I'm going to take to the next point of view. And I want to introduce you to the three-step model. And based on the three-step model, we are going to create three charts. Oh my God. But this will help you to actually, keep considering the movements in your minds. Issuer, three-step model, three charts. Holder, three-step model, three charts, so that everything gets binded in the minds. So let me now first introduce you to the concept of the three-step model. The three-step model which we are going to apply in terms of subsequent measurement of financial assets. This is dealing with the concept of subsequent measurement of financial assets. That if you're looking at the subsequent measurement of financial assets, we need to apply a three-step model. So let me first introduce you to the concept of what is this three-step model. So let me first give you a structure of the three-step model, and on that basis, we're going to make three charts with you. So what I'm going to do in terms of the three steps, now watch this carefully. In terms of the step number one, the standard requires the holder to step into the shoes of the issuer. Please hear this carefully. The standard requires the holder to step into the shoes of the issuer. I will ask a question to myself that as an issuer, the instrument is equity, the instrument is liability, the instrument is CFI. His financial liability, my financial asset called a debt investment. His equity instrument is a financial asset called equity investments. We're going to step ahead. Earlier we said his FL financial asset, his equity financial asset, his CFI financial asset. But now you need to go a step ahead. Financial liability is a financial asset debt investment. Equity instrument is financial asset equity investments. CFI is again debt investment. FL debt, equity, CFI debt. So in step number one, you need to categorize that is it a debt investment or is it an equity investment. So what do you need to do in terms of the step number one? Step into the shoes of the issuer. And then see what is the category from the holder's perspective. You need to step into the shoes of the issuer and decide the category of the holder in that particular case. So we will say, okay, if the instrument is a financial liability, it is supposed to be a debt investment for the holder. If the instrument is an equity instrument, then it is supposed to be an equity investment for the holder. And if it is supposed to be a compound financial instruments, it is again supposed to be a debt investment for the holder. This means at the very first instance, you need to step into the shoes of the issuer. I will basically evaluate that as a holder, what is the issuer calling the instrument? His FL, my debt, his CFI, my debt, his equity, my equity investment. So it does not literally mean that I'm going to call up the issuer and look at his classification, but every time you are acting as a holder, you need to evaluate things from the issuer point of view. You need to consider that if you were the issuer of the instrument, then would you call it as equity instrument, equity investments then? Financial liability, debt investments. Compound financial instruments, debt investments. The second step is on, and the third step is on the risk assessment. As I said, the risk assessment will decide what is the nature of accounting I'm going to follow. In my second and third step, I'm going to do a risk assessment. So let me tell you what you're going to do in the second and the third step on an overall, on a macro level. On the second step, I am going to put a question to the issuer. I'm going to put a question to the issuer. I'm not going to literally put a question to the issuer, but I will look into the issuer perspective as if I'm putting a question to the issuer. So I'll put a question from the issuer and identify that is the risk not there or is the risk there? Mind you, in step number 2, we are only looking at the presence or the absence of the risk. In step number 2, by putting a question to the issuer, I will only make an assessment whether the risk is there or not. So in step number 2, we are only looking at risk is there or not. The risk is there or the risk is not there, nothing more. I am not looking at whether risk is high or the risk is less. That's what I'm going to see in the step number 3. In step number 2, I will only focus on the point that, whether there is a risk or whether there is no risk. That's it. Then I'll go to the step number 3. And in terms of the step number 3, we are now going to put a question to the holder. We're now going to put a question to the holder in terms of the risk assessment. Now, in terms of the holder, I will put across a question. And I will now reconfirm that there is no risk. And if there is a risk, I will find out the intensity of the risk. So in this particular case, I will do two things. I'll either reconfirm that there is no risk. I will reconfirm that there is no risk. If I've reached a conclusion there is no risk, I'll reconfirm, yes, there is no risk. And if there is a risk, I will identify the intensity of the risk. I'll identify the intensity of the risk. Is the risk more or is the risk less? So I'll identify, is the risk more or is the risk less? Because depending upon the fact, let me ask you a question. If you reconfirm there is no risk, would you like to guess which approach would you apply?
AC.
Wonderful indeed. And if you reach a conclusion that the risk is more, which approach would you apply?
FVTPL.
Very good. And if you decide that there is less risk, which approach would you apply?
FTC, OCI, or reclass.
Okay, let's not get into R at this stage, but you're right. It is FPT OCI. So I think let me just quickly consolidate the inputs because we're going to make 3 charts on this. And the 3 charts are, we're going to make the first chart. If it is equity investment for the holder, then what? If it is a debt investment in this case, then what? If it is a debt investment in this case, then what? So you need to first get the structure very clear. When you are looking at the subsequent accounting of financial assets, the subsequent accounting of financial asset depends upon the 3-step model. So in the step number 1, you need to step into the shoes of the issuer. And you need to consider that his financial liability, debt investment. His compound financial instrument, debt investment. His equity instrument, equity investments. And then the risk assessment in step number 2 from the point of view of the issuer. We'll put a question to the issuer. What question we'll see? But the idea in the step number 2 is to see the risk is there or not the intensity, only the presence or the absence of the risk. So the presence or absence will be evaluated from the asking a question to the issuer. And in the third step, we'll do the risk assessment in terms of reconfirming that there is no risk, then AC. And if there is a risk, get the intensity, is it more or less, and decide the approach. So get the focus clear. Step number 2, issuer. Ask a question to the issuer. Step number 3, ask a question to the holder. And then accordingly, we get the conclusions based on this. So I think now we need to make a total of 3 charts with you. Having understood the concept of the 3-step model, now we'll make 3 charts with you. So let's begin with the first chart. I think let's make the first chart and then we'll give you a break after the first chart. Right? Then we will do the second, third charts after the break. So let's, I think, first create the first chart. So I am going to create a chart number 1. I am going to create a chart number 1. And first chart, we are considering equity instruments. So this is my chart number 1. So this is my step number 1, this is my step number 2, and this is my step number 3. So let's now go step by step. I'm going to put some questions to you. Watch me carefully as I do the talking with the issuer. So imagine the issuer is standing there for me, and then I'm going to do a talking with the holder. So when I'm going to speak to the issuer, he's on this side. I'm going to speak to the holder on that side. So we're going to put questions in step number 2 and 3. Let's begin. I looked at the instrument from the issuer point of view. It is an equity instrument. Would you like to define what is it from the holder's point of view?
Equity investment.
Wonderful indeed. It becomes an equity investment. Now I'm going to put the questions to the issuer. I'm going to put the questions to the issuer. Now see the questions I'm asking the issuer. I've put money into your company. Are you going to give me a return? What will he say? Yes or no?
No.
That's right. I put another question to him. I say that are you going to give me the principal money back after a certain number of years? What will he
No.
tell me?
No.
He'll say, I am not obliged to give you any returns. I'm not obliged to give you any money back until the company liquidates. And that also I'll give you money only if there is anything which is left over. He very categorically says, I've got no obligation to pay returns. I've got no obligations to pay principal unless the company liquidates, and that also you get money once the company something is left. So when I am looking at the question to the issuer, when I'm looking at a question to the issuer that is he going to pay me interest or dividend? The answer comes no. Is he going to pay me the principal money? The answer comes only on liquidation. Only on liquidation, that also if something is left. Does this mean that there is no risk for me? I put money in an investment where there is no guaranteed returns, no guaranteed principal repayment. Is there no risk or is there a risk?
Risk, sir.
Yes, there is definitely a risk. Because I am taking the public money and I'm putting that public money in a certain security where the other person says no return, no principal repayment, risky investment. Now, we go to the third step, and now I need to put a question to the holder in this particular case. So I need to put a question now to the holder. I'm now putting a question to the holder. I'm asking him, what is your intention? What will you do with this investment? Why did you invest in this equity shares? So in this particular case, I am interested in knowing his intention. That what is he going to do with this investment? Because he made an investment in the shares of a company. So I said, boss, what is your intention? He says, sir, I will do trading. I will do intra trading. So if he says that the intention is to do trading, is that risky, very risky, or less risky?
High risk.
Highly risky.
High risk.
Because if you're going to do trading in these particular shares, then it is high risk. If it is high risk, I think you can tell me which measurement base is to be applied.
FETPL.
Very good. So I'm going to use FPTPL because the risk is very high. Now, if I put across a question, what are you going to do with this investment? He says, no, I'm not going to do trading. He says, I'm not going to do trading. Does the risk slightly go down?
Not that high.
Moderate risk.
So we can say if there is, it's not trading, we can say the risk is less, not that high. There is less risk in this case. So would you like to suggest me a measurement base?
FETOCI NR.
Wonderful indeed. So this is going to be FPTOCI, fair value through other comprehensive income.
NR.
And this is no recycling. The Standard Set has decided that in terms of equity investments, it is going to be NR. There is going to be no recycling. If there is debt investments, it is going to be OCIR. Equity investment is no recycling, and debt investments will be recycling. But they also gave another interesting input. They said that you basically got a choice. You don't need to use FPTOCI. You can use FPTPL or you can use FPTOCI. Your choice. Your choice. So if it is held for trading, it is FPTPL. If it is not for trading, you get a choice. Unless mentioned otherwise in the exam, FPTPL is the default choice. Unless mentioned otherwise in the exam, FPTPL is supposed to be a default choice. So how would I come to know that we don't need to consider a default choice? Let me also tell you, this is an irrevocable choice. It is an irrevocable option. Once you choose a particular category, you cannot change. So this is one-time irrevocable selection. The company decides FPTPL, you cannot change. The company decides FPTOCI, you cannot change. But if the question is silent, we'll go to assume FPTPL as a default. So moral of the story, can I say, technically speaking, can I say by default all equity investments will be taken at FPTPL? Is that correct?
Yes, sir. For exam point of view, it's correct.
Yes, from the exam point of view, absolutely correct. But let me also tell you that this equity investments which we are talking in the standard is supposed to be unrelated party investments. It is unrelated party investments. If you've got related party investments, Ind AS 109 is not applicable. If you make related party investments, Ind AS 109 is not applicable. Related party investments are accounted under Ind AS 27 at cost or fair value choice. So this particular chart in terms of equity investments is applicable only to a situation where there is unrelated party. So when a company makes an unrelated equity investments, then this particular chart would apply.
Sir,
There is something more.
Sir,
Yes.
related party only cover JV, association, subsidiary, right?
Correct, absolutely. Your related party would be a subsidiary, would be an associate as well as a joint venture. That's correct. So they will be taken as per Ind AS 27. Financial instrument standard is not applicable to related party investments. So let me just, I think, consolidate the chart one. So can I say if the issuer issues an instrument and calls it as equity instrument, what is the holder going to call it as? He says equity instrument, what the holder is going to call it as? Equity investments. I will put the question to the issuer. Can I say the issuer? I'm going to put a question. Are you going to pay me interest, dividends, and the principal? The answer comes no. So can I say the step number 2 will always prove that there is a risk? Am I right?
Yes.
Because if you're going to make equity investments, you'll never get the right to receive any returns or the right to receive principal. So it'll always prove that there is a risk. So even if you don't apply much mind, the step number 2 will undoubtedly tell you that there is a risk. And then we put the question to the holder's point of view and we say, what is your intention? What are you going to do? The intention of the company could be to trade. If the intention is to trade, then it is very risky, FPTPL. But the intention is not to trade, then it is supposed to be called that it can be a choice, FPTPL or FPTOCI-NR. Now, let's give you one technical word before you give you a break. So let's give you a little technical word now at this stage. This entire exercise in step number 2 is called a test which is called CCFC, comprising SPPI test. The question which you're asking in this particular step is making a test which is called contractual cash flow characteristic. CCFC, contractual cash flow characteristic, comprising solely payment of principal and interest, SPPI. Solely payment of principal and interest. So what are we asking? Do you get the contractual cash flows comprising of the interest and the principal? So the technical test conducted in terms of step number 2 is called a CCFC, comprising SPPI test. So can I make a strong statement that this test will always fail in terms of step number 2? Yes. And when you're looking at the intention in step number 3, this is called a business model test. Sorry, not a business model test, sorry. This is called HFT test. This is called HFT test. It is called held for trading test. So when you're going to conduct the step number 2, it is called CCFC comprising SPPI test. And when you conduct the step number 3, it is called the held for trading test, because you're putting a question, is it held for trading? Yes or no? So it is called HFT, held for trading test. But the moral of the story is, the crux of the chart number 1 is equity investments are recorded at FPTPL by default. Now you would say, so why did you teach us this entire chart? I would have simply remembered that equity investments by default is at FPTPL. But I think now you've got the logic, you've got the essence. So let me ask you a small question. When I read a question and the question says a company invested in equity instruments, a company made an equity shares investment, unrelated of course, can I outrightly say FPTPL?
Yes, sir.
That's right. As an investor, when I see the question that a company invested in equity shares, unrelated party, FPTPL by default. If it says we did the irrevocable selection, we did an irrevocable option selection, FPTOCI. So the wordings may be that the company chooses an irrevocable option, FPTOCI, otherwise FPTPL. Right, friends, I hope the chart number 1 is pretty much clear. Then I think we can take a break at this stage and then carry on the chart number 2 and 3 after the break. Clear with the chart number 1, I guess?
Yes, sir.
Yes,
Very, very clear.
Wonderful indeed. So let's give you a break, friends. 10-12 minutes. I join you back in 10-12 minutes time, and then we'll do the chart number 2 and 3 with you. Enjoy your break. Thank you. We made a chart number 1, which is dealing with the concept of making investment in equity instruments. And the default measurement, as we've seen, is FPTPL. Now let's make a chart number 2. So let's create a chart number 2, which is going to be on a debt investments. So we'll apply a similar kind of a walkthrough and understand the measurement base in this particular case. So this is my chart number 2. Step number 1, step number 2, and step number 3. So let's now walk into the shoes of the issuer and see what the holder is going to classify this as. So let's say if the issuer, we step into the shoes of the issuer and we call it as a financial liability. So what is it going to be for the holder? Debt investments.
Sir, debt investment.
That's absolutely correct. It becomes a debt investment. Now, in step number 2, we are again going to put a question to the issuer and the test remains the same. The test is CCFC comprising SPPI test. Now let me put a question to the issuer and let's decide what answers do we get. So I'm now putting a question to the issuer back again. I'm saying, are you going to pay me interest over the life of the instrument? What will he say? Yes or no?
Yes.
Yes. I say, are you going to pay the principal money back after a fixed tenure? What will he say? Yes or no?
Yes.
Yes. So can I say in this case, the company will definitely get the right to receive the return, which is the principal, the interest or the dividend. And also you're going to get the principal money back. Because if the issuer is saying that it's a financial liability, he's got an unavoidable obligation to pay the interest and the dividend, which is return. He's got an unavoidable obligation to pay the principal money. His unavoidable obligation to pay becomes the contractual right of the issuer to receive. So that means the issuer is obliged to pay the return and the principal. The holder gets the right to receive. So what do you say? Is there a risk or is there no risk?
No risk.
There is no risk. Somebody might say, sir, there is a risk because he may not pay the money, but that's a different risk. That is a credit risk which will be evaluated separately. So at the moment, we are not looking at the credit risk, that is the failure of the issuer to pay the money. We're only looking at the right to receive. The issuer is under obligation to pay. The holder is got a right to receive. So I think that proves the point that there is no risk at the per se level. Then I go to the step number 3, a question now to the holder. Now the test name undergoes a change. Here the name of the test is same, but here the name of the test will undergo a change. And this is called a business model test. The intention in this particular case is called a business model test, which means the test in step number 2 is common for debt equity investments. But the test in terms of step number 3 is different. For equity investment, it is held for trading test. For a debt investment, it is called a business model test. Though this business model test is again looking at the intention of the holder. Now I'm going to put some questions to the holder and evaluate his intention. So let me put the question to the holder. I said, what are you going to do with this investment? So he says that I'm going to keep this investment till maturity. The issuer has got an obligation to pay. The holder has got the right to receive, and he plans to keep the investment till maturity and not sell it anytime in between. So what do you say? Is there a risk or is there no risk? Does it
No.
endorse the fact that there is no risk?
No risk, sir.
Absolutely. So if the intention is to keep the investment till maturity, then we can say that there is no risk because the issuer is obliged to pay, the holder has got the right to receive, and he doesn't want to forego his right. He wants to exercise the right to keep the security till maturity. So what will be the measurement base in this case?
Amortized cost.
Wonderful indeed. It becomes an amortized cost approach. Let's look at further combinations of intention. So I now put across a question to the holder and say, what are you going to do with this investment? And he says, I'm going to do trading. Just like equity investments, I'm going to do trading. So what do you say? If he's going to do trading, is there a risk?
High risk.
Yes.
Wonderful indeed. So if he's going to do trading, then there is high risk. And I think you can easily decide that if there is a high risk, then what kind of measurement base will I apply?
FETPL.
Wonderful indeed. It's going to be fair value through profit and loss because the risk in this case becomes high. Now, let's go to the other situation. Let's again put the question to the holder and ask him what is the intention. Now he says, my intention is not to keep it till maturity, but intention is also not to do trading. I might do any of the two. He says, I don't have a fixed objective. I might keep it till maturity. I might do a trading. It all depends. So can I say I am in between the two situations? So if I am in between the two situations, can I say it is a situation of no risk and high risk in between? Can I say it indicates a less risk?
Not that high.
That's right. And therefore, we should apply FPTOCI. And this is going to be R. As I already made a mention that in terms of the debt investments, it is always recycling and equity investments is always no recycling. I presume, you know the concept of R as well as NR. Do I need to give you any walkthrough on the same? Or can I safely assume you know what is R and R?
Sir, R means we can reclassify into the
Reclassify to the P&L.
P&L.
Yes, so I don't need to tell you the integrities of what is R and R. How does the movement happen? Can I safely assume that to be a yes?
Yes, sir. Myself.
Okay,
Yes.
wonderful indeed. Okay, so I think let me now also tell you one more thing before we close this particular chart, and that is in this case, if you say it is amortized cost, and in this case, when you say it is FPTOCI, in this case, we can also apply an FPTPL instead of using AC. Instead of using AC, instead of using FPTOCI, the company can use an FPTPL. But this is not a choice, it's a conditional choice. If you want to use FPTPL, this is supposed to be a conditional choice. So what is the condition if a company wants to exercise this particular choice? The standard says it should reduce or it should eliminate what is called accounting mismatch. If I want to use this particular approach, that means instead of AC, I want to use FPTPL. Instead of OCI, I want to use FPTPL. The company needs to prove that it will eliminate or reduce the accounting mismatch. I think I'll not get into that part at this stage. So this conditional choice means that this will either reduce or this will eliminate. This will either reduce or this will eliminate, you can say, accounting mismatch. It is only if you're able to prove the reduction or the elimination of the accounting mismatch, then alternatively FPTPL can be used, otherwise AC and OCI continues. Let me just consolidate the chart number 2 as well. So my mind is now thinking that if it is supposed to be a debt investment, issuer financial liability is my debt investment, can I say step number 2 will always be met? Just like equity investment, step number 2 will always fail. Can I say in terms of this debt investment, the step number 2 will always pass? That's a question. Can I undoubtedly say that for a debt investments, you will always pass the CCFC SPPI test? Yes.
Yes.
And therefore, everything is completely intention based. You plan to keep it till maturity, AC. You plan to sell, it is FPTPL. It's a mixed objective, FPT OCI. So, moral of the story. I'm going to make now 4 statements. You decide the measurement base. Can I say if a company makes a equity investment? Of course, I'm assuming unrelated party. Give me the measurement base. My company
FVTPL.
makes a equity investments in unrelated party. Give me a measurement base.
FVTPL.
Wonderful indeed. But if the company chooses an irrevocable option, then give me a measurement base.
FVOCI.
Wonderful. R and R. R and R for equity. NR. Next, if a company makes a debt investments with the intention of maturity, give me a measurement base.
Amortized.
Wonderful indeed. If a company makes a debt investments with the intention of trading,
FVTPL.
wonderful indeed. And if the company makes a debt investments with a dual objective, holding or selling, whatever.
FVTOCI.
And that's R. Wonderful indeed. So I think we made a point on the chart number 2 as well. I hope I'm clear with the chart number 2. Now let's go to the chart number 3. So we're going to make a chart number 3, and that will give us the inputs in terms of accounting of financial assets, and combinations. So we're now making a chart number 3. Step number 1, step number 2, and step number 3. So now let's consider that the issuer issues an instrument which is a compound financial instrument. So you step into the shoes of the issuer. You step into the shoes of the issuer, evaluate from the holder's point of view. If the issuer says it's a compound financial instrument, what will the holder say? His
Debt,
CFI is my debt investments, correct?
debt investment.
That's right. It becomes a debt investments for me. Now here again, I'm going to apply the asking a question to the issuer, and the test, of course, again remains the same. And that is CCFC comprising SPPI test. Now please hear this carefully, a very crucial point. Can I say generally, I'm just giving you a journalic view. Can I say generally, if you look at compound financial instruments, they will be optionally convertible debenture. I don't say that other instruments cannot be CFI. But generally, when you look at the concept of CFI, what generally comes to my mind is an optionally convertible instrument. So let me ask you something. Is the holder going to get cash for interest and principal? Or he might get shares for the principal? As a part of the return, the holder will always get cash for the principal, or he may get shares for the principal.
Shares for the principal.
That's absolutely. The name of the test is contractual cash flow comprising solely, the word is solely, payment of principal and interest. So the name of the test is that you get the principal and the interest solely in terms of cash. And in this particular case, considering a compound financial instrument which is optionally convertible in nature, you will not get the principal solely in terms of cash. So this test generally will fail. And I think you can make an input that if this test fails, that means you're not getting the right to receive the principal and interest in cash. So does this mean that there is a risk or there is no risk?
Very high risk, risky.
Yes. So there is definitely a high risk, and the standard says there is no. Step number 3. If you make investments in debt investments, which are CFI for the issuer, there is no need to apply a step number 3. The failure of the step number 2 will directly lead to the conclusion that we are applying FPTPL because it is considered to be high risk. Investing in instruments which is supposed to be a CFI is a risky investment, and therefore FPTPL will apply. Wow. So I think now my mind stands clear that what is the accounting of the financial assets. I'll still like to get back on the initial chart where we decided the input in terms of the financial assets accounting. So let me just come back on the agenda and now see this particular chart on a consolidated level. So as I said, I am concentrating on the holder. It's not that we're not going to discuss the issuer. We will come back to the issuer as well. But right now the focus is on the holder's perspective. So when you're looking at the holder's perspective, the financial assets initial recognition is at a fair value, with the two exceptions where the initial measurement will be at a transaction value. Now let me also introduce the other chain at the back of your mind. So which means that if you look at this particular situation, when the initial recognition will be at a fair value and there is a difference in terms of transaction value. This is now another offshoot which is coming for discussion. That if you're going to record the assets initially at a fair value and the transaction value differs compared to the fair value, how do you account for the difference? That will be a special issue of discussion which we'll do later. So we'll be coming to the agenda that if the initial recognition is a fair value and there is a difference in the transaction value, how is that difference accounted for? How is that difference accounted for? So that is a special area which we will discuss later. When it comes to a subsequent measurement of the financial assets, depending upon my three-step model, which you have now known, I will apply AC, OCI, or FPTPL. And this OCI has got two variations. One is a concept of NR, which is applicable only to equity, and one is a case of R, which is applicable only to debt investments. Now, what I need to do, friends, is do questions with you. I would say I need to do a total of how many questions? I think I need to do a question, debt investment AC, done. Debt investment OCI, debt investments FPTPL, equity investments OCI, equity investments FPTPL. 5 questions, then you get a complete clarity in terms of financial asset accounting. Out of these 5 questions, I've already done one. I've already done the case of a debt investments accounted at AC with the concept of EIR. I'm going to do the same question which I gave you for a debt investments. I'll do that with FPT OCI. I'll do that with FPTPL. Then we'll look at equity investments, FPTPL, FPT OCI. After we've done all the 5 cases with you, then the plan is to make a comprehensive chart, giving you all the insights in terms of which particular permutation combination applies in which case. So I think we'll do the chart after we've done the questions with you. So I think let's go one by one. So I think I started my journey. I'll call this as case number 1. I'll call this as case number 1. This is debt investments at amortized cost. So this becomes my case number 1, debt investments at AC. Now you very clearly know how the financial assets at AC is accounted for. So let's, I think, now go to the next case with you. So I'm now going to take you to the next case, and that is case number 2. The same question we are going to do. I want to see the debt investments at FPT OCI, and that is always R. So I'll do the same question, do the case number 2, same question, do the case 3. So debt investments AC, OCI, P&L will get taken care. So let's now make a ledger account again. So this is the financial asset account which is prepared at FPT OCI, that is recycling. Now let's come back on the agenda. So what is the value at which the financial asset is invested? We invested 95,000 and there was a 2,000 TC. The initial recognition is now going to be at fair value plus TC. Remember, when I gave you the initial chart, I said the financial assets are measured at fair value. I'm making an amendment. It'll be at a fair value plus a TC. It might not include a TC in some cases. But you need to be careful now category wise. In a general sense, financial assets are taken at a fair value, but in a more specific category, in AC, it is fair value plus TC. In OCI, it is fair value plus TC. But in FPTPL, it will be just at fair value. No TC will be added if it is FPTPL. Don't worry, we'll document that. So I made the investment. I said this is 97,000. So this is plus another transaction cost to the extent. Now, a very crucial question comes into the mind. Are we applying the concept of EIR in terms of FPT OCI? What do you say? Would the concept of EIR apply in terms of debt investments at OCI?
Debt investment, it will applicable, sir. Amortized cost plus including the FE through OCI or reclass.
Wonderful indeed. So many people at time get a little confusion. They believe that the concept of EIR is applicable only in terms of AC. It is applicable to AC as well as OCI. It's applicable to debt investments, not equity. Equity investments, we never use the concept of EIR. Equity investments, whether they are FPTPL or whether they are FPT OCI, there is no concept of EIR. EIR applies only to debt investments at AC and OCI, not to FPTPL. So which means that when you are going to consider a finance income, you need the same finance income. You need the same finance income as AC. You need the same finance income as AC. Every year, the finance income which will be captured is going to be the finance income in the AC ledger. Now, there are two ways of calculating this finance income. Year one is not a problem. Either you make a working note in the exam, make a separate ledger in the exam as far as financial asset AC is concerned, and then create a financial asset at OCI so that all the finance income is available. Or you can even do it in this case as well. But I think since I have the figures, I'll just pick up the figures. So what was my finance income for the year one? In the AC ledger, what was my finance income in the AC ledger?
7,760.
7760, and you get the coupon rate on 1 lakh rupees at 5%, that is 5,000. Now, if you're using FPT OCI, I cannot take the balance CD as a balancing figure. In AC, I was considering the balance CD as a balancing figure because there was no fair value concept to be applied. But in this case, we need a fair value. I think I'll just revisit to you on the question. And you can have a look at the question again. I am given the fair value at the end of December X1, that is 1,10,000. I'm also given the fair value at the end of second year, that is 1,04,000. But I am not given the fair value at the end of third year because I don't need that. Because the maturity is happening at the end of third year. So let's consider the fair value. This is 1,10,000. So I am going to record this at a fair value. So this is not a balancing figure, but this is the fair value. So can I say there will be a balancing figure in this ledger, and that balancing figure would represent, can I say the fair value change? And can I say that fair value change will enter the other comprehensive income? Am I right?
Yes, sir.
Correct. So let's see the balancing figure.
10,240.
Okay, that's on the credit side, I guess.
It's a profit.
So it's on the debit side. Is it coming on the credit or the debit side?
Debit side.
Okay. So we're getting the figure on the debit side, and that is 10,240. So I'm just putting it out here, 10,240. So this will be entered in the other. So when you take this in the other comprehensive income, from the OCI, it will be taken in SOKI. In which tab number? Can I say this amount is going to be accumulated? This will be accumulated in SOKI. because whatever is taken in the other comprehensive income is going to be accumulated in SOKI. Year by year, you're going to put that money in the statement of changes in equity. And can I say this will be inserted in tab number 3. Do you want me to make an extract of the other comprehensive income also to give you some inputs, or is that fine if I don't make it? Do you want me to make the OCI extract also, or can I skip that? Yes, Alan seems I think we can skip the OCI context in this case. Okay. So let's go to the next year now. So we take the balance BD as 1,10,000 because I had some intentions to give you the OCI, but I think since nobody wants it, then I think let's skip it. Okay.
No, we want it, sir.
So please,
But nobody wanted it. I asked 2 times, nobody said yes. Okay, then we make an OCI. I'll give you some more inputs through the OCI. So again, give me the finance income from the AC ledger because we can't take the finance income of 110. Look at the finance income in the AC ledger.
7981.
7981. And again, you receive that coupon rate, which is 5,000. The balance CD again will be taken at a fair value. Will not take a balance the fair value at the end of the year. So let's again see what is the balancing figure in this particular ledger. I think it's coming on this side, 8981. That is again going to be taken in OCI. That's a loss. It's
Yes,
a fair value loss.
Yes, sir.
So now we again take the balance BD, which is 1,04,000. Now, in this particular case, let me remind you, there was a dual objective that we might hold the investment or we might sell the investment. Technically, you can see that I'm not selling the investment. But I'll take a second variation with the OCI extract that let's say if you would have sold the investment, then what? So let's, I think, make the third year. So right now we decided a dual model, but let's say we are assuming that no sale took place. Let's get the France income third year from the AC leisure.
8219.
8219. And then I consider bank. So since we're holding till maturity, can I say we're going to get the principal with the premium as well? So
Yes,
we
sir.
get the interest and the principal premium. Let's see now what is the balancing figure
12559.
on the debit side, I guess, or on the credit side. I think it's on this side,
Credit side.
1259. That is other comprehensive income. Now, before we make the OCI extract, I think I want to do some analysis from this ledger itself. Let's look at the fair value gains and the fair value losses in all 3 years cumulatively put together. So there was a fair value gain of 10,240. There was a fair value loss of 8981 and a fair value loss of 1259. Can you just add these figures up? This is the gain, this is the loss, this is the loss. So this minus was how much?
0.
Okay, that's right. Okay, I think Krish, you've got a question. So that's rightly said, the net balance becomes 0. So my question now is this by chance to be 0 or is this got to be?
Got to be, sir.
Yes. Because at the end of the day, if you do not sell the investments in between, you kept on holding till maturity. So what will happen if you keep holding till maturity? You never realize the unrealized gains or loss. Because what you were capturing in the OCI was the unrealized gains or the unrealized loss. If you don't sell the investment, the cumulative unrealized gains and losses at the end of the year has to be 0. I hope the AC leisure is clear. Can I now complicate this by taking you to the extract, compare the AC and the OCI? Oh, yes. Let's have a look now further. I want to also now consider a statement of changes in equity, I'm going to look at the extract of SOKI in this case. So this is my SOKI, tab number 1, tab number 2, and tab number 3. Just to remind you, this is the equity component of CFI. This is the reserve and surplus, and this is other comprehensive income. Now let's do the posting in terms of the ledger account. Can I say there was a gain 10,240? So I would have recorded this out here.
Yes, sir, on the positive.
10,240 in the other comprehensive income. Let's assume that you made a sale of investment at the end of the second year. I want to make a ledger account as well. I just want to show you the comparative position. So let's say you are making the ledger and in the second year you made a sale. Let me just take the figures out here. So can I see the opening is 1,10,000 and the finance income is 7,981 and there is a interest coupon rate received 5. And let's say I made a sale of this investment instead of keeping the investment. Let's say I made a sale of this investment. Can I say I made a sale at the end of the year? So can I say the sale will be made at 1,10,000? That is the fair value. So I made a sale at 1,10,000. Can you tell me what is the profit on sale? So 1,15,000 minus 117,981. I guess we're getting a balancing figure 2,981, is it?
Yes, sir.
So this was 1,10,000. No, it was, sorry, 110 was first year, sorry. This is second year ledger. So we'll sell it at a fair value, 1,04,000. I took the first year by mistake. 1,10,000 was fair value at the end of first year. We're taking the fair value at the end of second year. So we made a sale at the end of second year. Let's see what is the profit loss on sale.
8981, sir.
So we're getting 8981 is the loss. Where will you pick this 8981? The loss will be taken where? OCI or the P&L?
OCI, sir.
No. It'll be in the P&L. The profit or loss on sale is a realized gain or loss, and that will enter the profit and loss account.
Sorry, sir. It's a profit and loss. Okay, it will be
Yes.
go for P&L. Yeah, got
Correct.
it.
So when you made a sale of the investment, the gain or loss on sale enters the profit and loss account. Now, let's do one simple little calculations further. I also want to look at the extract of my profit and loss and OCI as well. So this is my income statement which I'm making. This is year 1, year 2, year 3. Your income statement is comprising of two elements. One is the profit and loss and one is the OCI. Can you tell me in the first year, did you take anything in the P&L? Look at the ledger and tell me clearly. In the first year, did you take anything in the P&L?
No.
Finance
First,
income?
first year we took only for dividend. That 5,000 we
Finance
took it
income.
for.
So 7760 finance income was taken in the profit and loss credit. Is there anything which is taken in the OCI in the first year? Yes.
Yes, sir. 10,240.
10,240 is taken in the other comprehensive income. Can I say in the second year again, you took that 7981 as a finance income? And can I say there is a loss? So I'm taking this in the brackets, 8981 brackets. So you took the loss in the P&L, you took the finance income in the P&L. Anything else to be done?
Yes, sir.
Can I say the accumulated balance in tab 3 will also go into the P&L? Am I right?
Yes, sir. We need to reclass.
So this 10,240 is also going to be taken in the P&L. So we will 10,240. So I just want the figure. I just want this figure. Can you give me 8981 and 10,240? What is the net figure? This is the gain and that is the loss. So what is the net figure in the P&L?
1259.
1259.
Yeah, 1259.
So can I say the profit and loss gets a credit of 1259 on account of sale of the investment effectively, correct?
Yes, sir.
Now let me do one thing. Let me also make this is an income statement when we are following the concept of FPTOCI. I also want to look at the income statement extract. I also want to look at the income statement extract if I was taking AC. I also want to look at the income statement extract if I'm looking at AC. I've already made the leisure. I just want to see the comparative income statement if amortized cost approach was applied. So let's again take the year 1, year 2, and year 3. So this is the P&L and this is OCI. Did you take anything in the P&L in AC?
Yes,
Can I say
sir.
the same finance income?
Yes, sir. Finance
Whatever
income will come.
finance incomes you have taken would have been taken in AC as well. So you would have taken 7760. You would have taken 7981 in the first and second year. But you did not take anything in the OCI. You did not take anything in the OCI. Now let me just get back to the AC leisure. I'm just going to go back to the AC leisure to get the funda. Now please look at the facts. If this investment was sold at 1 lakh 4, if this investment was sold at a fair value of 1 lakh 4, would you like to give me what is the profit or loss on sale? This is the book value of the investment and it is sold at 1 lakh 4. What is the profit on sale?
1259.
259.
Very good. So if I would go back to my extract P&L, can I say I would record a profit on sale that is 1259. This 1259 and this 1259 by chance or got to be?
Got to be, sir.
It is 100% got to be the entire analysis correct. At the end of the day, you would see that even if you consider fair value through OCI, the profit or loss on sale of the investments will always equal if you would have sold the investment in AC. I know in AC, the objective is not to sell. But still, nevertheless, the company can make a sale of investments, one of its kind. Because even though the business model is holding the investment till maturity, but if there is a huge credit risk which a company is facing on a particular investment, they can always sell the investment. So the point which I wanted to make is that in terms of AC, if you sell the investment, you get a profit on sale 1259. Even in terms of OCI, if you sell the investment, your profit on sale, of course, will be the same. It cannot be different. Because when you transfer the accumulated amount in tab 3 in terms of the profit and loss and recycle it, the ultimate profit or loss is 100% going to be the same. I hope my position is clear. The case number 2 is clear.
Yes, sir. Clear, sir.
Great. Now let's go to the case number 3. So debt investment AC is done. Debt investments OCI is done. Now we need debt investments at FPTPL. Then we'll talk of the equity investments, the two cases. Then we need a comparative chart also, which we'll come to that later, maybe tomorrow. Early in the morning, we're going to make a comprehensive chart indicating the comparisons of different inputs. Because in that chart, we'll also like to incorporate other factors also, which may not have been discussed out here. We are considering a debt investments at FPTPL. So let me, I think, remind you first of all, one input. The concept of EIR does not apply. The concept of EIR is limited to debt investments and that also AC and that also OCI, not P&L. So the first thing which you need to keep in mind is the concept of effective interest rate is not applicable to FPTPL category. The second input which you need to be clear on is that when you record the initial measurement, when you consider the initial measurement in this particular case is supposed to be at a fair value. You are not supposed to add the TC. If there was debt investment AC, it was fair value plus TC. It was FPT OCI, it was fair value plus TC. In FPTPL, it'll be just at fair value, no TC to be added. The TC is immediately expensed off. It is immediately expensed off. It goes in the profit and loss account. It is not added to the financial asset. So life becomes more easy. That no TC is added and the concept of EIR does not apply. So let's see on a time scale. On a time scale, this is time 0, this is year 1, this is year 2, and this is year 3. So let's see the journal entries which we will pass in terms of debt investments at FPTPL in this particular case. The initial recognition is at a fair value, so I'll put the entry, financial asset gets a debit and the bank gets a credit. And can I say this is going to be at 95,000?
Yes, sir.
Unlike 97 in terms of the other two cases. And as far as the TC is concerned, profit and loss gets a debit and the bank gets a credit. And can I say this will be immediately expensed in the P&L?
Yes, sir.
Wonderful. Now let's see the entries at the end of the year. So what was the fair value at the end of the year? I think it's 1,10,000. Then the fair value at the end of second year is 1,04,000. So now you need to compare what is the change in the fair value. So what is the change in the fair value from 95 to 1,10,000? There is a fair value gain of 15.
15,000.
So where will you take this gain of 15?
P&L.
P&L, because it's FPTPL. So we'll put the entry, financial asset gets a debit and the profit and loss gets a credit. And this is to the extent of 15,000. And what about the finance income? Are you going to consider the finance income to be that coupon rate of 5% itself? Yes. So whatever coupon rate of 5,000 you receive, that is a finance income in the P&L because EIR is not applying. So I'll put another entry. That is bank account gets a debit and the finance income gets a credit. And can I say this is to the extent of that coupon rate of 5,000?
Yes, sir.
So what we're doing? Yes, yes. So what we're doing, we're capturing the fair value changes and we're recording the actual interest income in the P&L. So whatever interest income is received in actual, that itself gets captured in the P&L and the fair value changes in the P&L. Let's go to the second year. Can I say in terms of the second year, now what is the fair value change? Can I say it's gone down from 1,010 to 1,04? So the entry will be profit and loss gets a debit and financial asset gets a credit. And this is to the extent of 6,000.
6,000.
And this entry again will be repeated. So we again put the entry, bank gets a debit and the finance income which goes in the P&L gets a credit to the extent of 5,000 and so on. So I think I'm not interested in the third year. So this is how the accounting will go on in FPTPL. Trust me, even equity investments at FPTPL will have a similar accounting, absolutely. I will have 100% similar accounting, though to avoid any confusions, I will give you the separate case. But I think now we're done with three cases. Debt investments is done. Now you know the debt investments at AC, you know the debt investments at FPT OCIR, you know the debt investments at FPTPL. Now we need to do the two cases, equity investments FPTPL, equity investments FPT OCI. I hope the third case is also very clear.
Yes, sir. Clear, sir.
So we'll be doing a lot of questions also tomorrow because I thought, let's revise the concept so that we get the concepts clear and then we practice as well. So let's now go to the case number 4. So on the case number 4, we are now focusing on equity investments. We're now focusing on equity investments at FVTPL. So in general, as I've already made a statement, the concept of EIR is not applicable to equity investments any case. So I think let me put it point blank. that as far as the concept of EIR is concerned, it is not applicable for equity investments, irrespective whether they are taken at FPTPL, OCI, whatever. The concept of EIR is limited only to debt investments which are carried at AC or carried at OCI. So I think let's take the same example. Let's take the same example to understand the accounting of this equity investment. Time zero, first year, second, third year. So my fair value out here is 1,10,000. My fair value out here is 1,04,000. So accounting, which you will see in terms of equity investments, absolutely similar to what is there in terms of debt investments, 100% same. But I'm just doing it for convenience, but the accounting is 100% same. So let's consider the entry at the beginning. Financial asset gets a debit, bank gets a credit. Is it going to be 95 or is it going to be 97?
97.
No.
No, FT
FPTPL,
is not applicable, no?
yes. FPTPL, the financial asset will be at fair value only, debt, equity, irrespective. So
Yes, sir,
this
it's
is going to be
going.
same accounting, 95. And the transaction cost will be immediately expensed in the P&L. PL gets a debit, bank gets a credit to the extent of 2,000. Now we consider the fair value change. From 95, it became 1,10,000. So where do you put the fair value gain?
P&L.
Yes, it is FPTPL, so we're going to put that in the P&L. So in this particular case, the entry is the same. Financial asset gets a debit and P&L gets a credit to the extent of 15,000. And can I say if there is any dividend income? If there is any dividend income that will go to the P&L? I'm not taking that 5,000 coupon rate because equity investments will have dividends. So if you receive any dividends, the dividends will also be taken in the P&L. Let's now go to the second year. Can I say in the second year again, there is a decrease of 6,000. So you're going to put a reverse entry, P&L gets a debit and the financial asset gets a credit that is to the extent of 6,000. And again, the dividend income will also be taken in the P&L as the case may be. So is the accounting absolutely similar to the case number 3?
Yes, sir.
Yes. In terms of debt investments, the actual interest goes in the P&L. In case of equity, the actual dividend goes in the P&L. At the end of the day, we are capturing the fair value changes in the P&L. Whether it's a gain, whether it's a loss, whether it's a fair value increase or fair value decrease, everything is getting captured in the profit and loss. So I think the case number 4 will also be pretty much clear indeed. I think so. Correct.
Sir, is that with respect to derivative investment?
Okay, you're talking about the financial asset. Now, this accounting, what we're doing is not applicable to derivative. Derivatives actually is always at FPTPL. So if you say that it's a derivative financial asset, then the accounting, what we're doing is perfectly applicable. But derivatives in general are all accounted at FPTPL. That's right. Whether it's a financial asset, financial liability, it's M to M, mark to market.
Okay, sir.
Okay, great. Now let's come to the last case. That is the case number 5. And what we're going to do, tomorrow we're going to add Ind AS 21 along with Ind AS 109. There have been some interesting questions. What I've actually done is also, I did not touch upon this, but what I've done, I've created some super 20 questions for practice as well. I did not touch many of these questions so far. But we'll be doing some of these questions, which are, the most comprehensive questions on the area. So in this, I've got some collection of questions as well, where there are questions which came in RTP in, I guess, in one was question number 6. So this came in the exam. One was RTP May 20 and RTP November 20. So tomorrow our inputs will be doing more questions with you. The concept is done. Tomorrow we'll do a lot of extensive practice on the area because there are a lot of areas further in this particular standard. Because apart from the financial assets, we need to understand the financial liability accounting, which is simple. Then we also need to understand the derecognition principles. Then we also need to understand impairment. Then we also need to understand hedging. Step by step, nobody. So now let's come to the case number 5, where we're looking at equity investments at FPTOCI, R&R. This is no recycling. Equity investments is always without any recycling. So now let's consider the same time scale to understand the accounting. So please do revise today's class very well, because when I'm going to make a chart, I want that everything should be very crystal clear in the back of the mind, because we're going to see a lot of parameters in terms of what is done in each and every individual case, because we'll look at the different aspects of accounting: AC, OCIR, OCINR, FPTPL separately. So 0 point of time, first year, second. So when you made the investment at time 0, now be careful, you are going to record this investment at 95 or 97.
97, sir, including
Wonderful
transition cost.
indeed. That's right. It is only debt equity investments at FPTPL are taken at 95 fair value. Rest all the cases TC added. So this becomes 97. Then at the end of the first year, the fair value is supposed to be 1,10,000. At the end of second year, the fair value is supposed to be 1,04,000. So can I say there is going to be a change in the fair value? So what is the change in the fair value? I guess 13,000 gain. And where will you put this gain of 13,000?
OCI.
Correct. It'll enter in the OCI and it'll be accumulated in the SOKI in the tab number 3. And will that amount be taken in the P&L on sale or directly shifted to the tab number 2, retained earnings?
Retained earnings.
Correct. So let me also point out here that this amount is going to be accumulated. This amount is going to be accumulated in SOKI. And that is going to be in tab number 3, which will be transferred to tab number 2, that is basically retained earnings on sale. So it will not be recycled in the P&L, but it will be simply transferred in the tab number 2, retained earnings on the sale of the investment.
So here also the EIR is not applicable, right?
EIR is not applicable.
Not applicable.
Equity, yes. Equity investment EIR does not apply. OCI, P&L, whatever. Then again, we consider the fair value changes is 6,000. So we put a reverse entry. OCI gets a debit and financial asset gets a credit. And that is to the extent of 6,000. And what about the dividend income in these cases? Where will the dividend income go? OCI or the profit and loss?
Dividend income always P&L.
Correct. So any kind of dividend income which you're going to get in this case is going to be taken in the P&L, just like P&L, OCI, the concept is same. So dividend income enters the P&L in all these years. Super. Fair value changes, which is getting captured differently. The initial recognition is getting accounted differently. Otherwise, I guess the concept is 100% the same. Right, I hope I am clear with all the 5 cases. Now you know the debt investments AC, EIR, OCI, EIR. Rest of the cases, no EIR. Debt investments, FPTPL, no EIR. Equity, OCI, equity, FPTPL, no EIR. EIR, remember, is applicable to debt investments at AC, at OCI. Second crucial point is all these financial assets are taken at fair value plus TC. It is only for FPTPL, debt equity, no TC added. Only the recognition is at a fair value. And the changes when it goes in the OCI for debt investments accumulated in tab 3 and then taken to the P&L. It is the case of R. Equity investments, the fair value changes accumulated in tab 3, but that's taken in the retained earnings directly because it is a case of NR. So all my 5 cases are done. Conceptually, I'm done. Now what I'll be doing, not today, in the tomorrow's session, I will first of all make a chart at the very inception. Try to make a summary points in terms of what is done in each and every case. After the summary chart is created, then I will come to the next aspect and we will do some questions with you, especially combining Ind AS 21 as well as the concept of Ind AS 109. And then we'll carry forward the journey further. Right, friends, any questions on your side?
Sir, on the profit on sale or loss on sale with respect to equity investment, on when we choose the FV through OCI NR category, that loss and profit will go to OCI.
OCI.
Not to P&L.
Not to be annulled. So debt investments, profit loss on sale goes in P&L, equity will go to OCI. I'll incorporate that part in the chart tomorrow as well. You're right, absolutely. Equity investments, the fair value change, OCI, the profit loss on sale, OCI.
Right, sir. Thank you, sir.
You're most welcome. Right, friends. So I think that brings us to the end of the discussions today. So it was wonderful. So we'll see you tomorrow morning again. Please revise all this inputs, what we have done. Going to see you in the tomorrow morning. Thank you very much. Enjoy your Sunday. See you tomorrow morning. Thank you. Bye-bye and take care.
Thank you, sir. All the 3 hours is just gone with interestingly.
We are enjoying the class also, sir.
Thank you so much indeed.
Take one more class after tomorrow on this, and we'll be through with this.
So
Student,
we have 5 classes allotted for this. So today is the
Okay.
second one. We got 3 classes more: Monday, Wednesday, Friday.
student, in evening today is another class or 4 FR.
Today, I think no class.
Yes,
FR,
yes.
we have scheduled.
Yes, there is a class.
Yes, one more class is there.
Yes.
Aditya's.
115.
Yeah.
That
yeah.
was left now.
Yes, yes. Sir.
Okay.
Sir, we enjoyed
Thank you
your
very
class.
much.
We enjoyed your class thoroughly, sir. Thank you so much.
Thank you very much indeed.
Thank you, sir. Thank you.
Thank you, sir.
Thank you, Hanji. Thank you.